In our last video, we learned about bonds and CDs. If you haven't seen part 1 of our videos, you can click on the link that appears on the top right corner. To watch our upcoming videos, please subscribe to our channel. Now in this video, let's talk about ETFs and mutual funds and how they can be a viable investment option for your money to grow. Let's keep Charlotte as an example again. Charlotte, as an investor, wants to minimize the risk on investment by diversification. She wants to invest in multiple assets as compared to investing all her money into just one asset. This is so the chance of losing money is less. Charlotte has very little money to invest, and she is finding it really hard to invest and have a diversified portfolio. That's when she comes to know about ETFs and mutual funds, but she doesn't know much more than that. ETFs, or exchange-traded funds, and mutual funds are a collection of stocks, bonds, commodities, and currencies which are created in a basket, so to speak. Investors can buy a share of that basket just like buying shares of a company. Charlotte can buy and sell a basket of assets without having to buy all of them individually. There are so many variants of baskets. Some of them replicate indexes like S&P 500, Dow Jones, and NASDAQ. Some of them replicate a specific sector such as technology, energy, and finance. Each fund is different from one another. Risk and rewards are based on the market condition and various other factors. Positive returns from funds is of two ways. 1, increase in fund price. 2, dividend yield, which ultimately varies based on the fund. You can find this out by looking at the fund information. Charlotte has gained some fundamental information on funds, but she doesn't understand the difference between these two funds. Here are some basic differences. Mutual funds are actively managed, meaning the underlying assets are traded frequently, so the cost of managing the fund is high. ETFs are usually passive funds with very less fees or expense ratios. Expense ratio is one of the crucial factors to look at before buying a fund. High expense ratio might seem negligible at first, but it will affect your total return when you cash out. Mutual funds can be traded only after the close of trading, whereas ETFs can be traded throughout the market day and extended hours, so ETFs have high cash liquidity. Mutual funds are required to disclose the underlying assets only once in a quarter. Any major changes before or after investing, you will come to know only at the end of the quarter. In contrast, ETFs will disclose on a regular and frequent basis, so investors know what they are investing in and where their money is parked. ETFs also have greater flexibility because they can be traded like stocks. You can do things with them you can't do with mutual funds, including writing options against them, shorting them, and buying them on margin. Looking at the comparison, Charlotte thinks ETFs are the best option to invest in, and she now wonders why mutual funds even exist. As we learned earlier, mutual funds are actively traded, so there is higher chance of having greater return, but it comes with a higher risk of losing money as well if the underlying asset is not performing well. So there you have it. Now Charlotte is confident with which option is good for her and how she can leverage each one's benefit. Tell us about your thoughts on these investment options. Thoughts such as what and why you would choose to invest in these funds and help out the community.